series trust provider, so I encourage you, if you're thinking about launching a mutual fund, you definitely should have a conversation with Kevin Garrett. And with that, I think I covered everything. I'd like to turn it over to Chris O'Grady, longtime friend and business partner, to interview the RIA channel.
Thank you, Guy.
Yep, thanks.
I want to thank everyone for being here. This is great. Chris O'Grady, the Chief Investment Officer of Dakota Funds. We have a great panel lineup, and I just want to start with Kareem. Let's just briefly introduce your firms, and I'll jump into the questions.
I'm Kareem Ahmed, and I'm a partner with the Chicago office of HBM Partners, registered investment advisor, multiple offices around the country, dealing mainly with wealthy families and private clients.
Gil Calderon. I'm the Chief Investment Officer of M4 Capital Management here in Chicago. We're a single-family office, investing across all asset classes with the exception of venture capital. And we have an additional office in Phoenix where our family is based, but we're just up the street here.
Lyle Minton, CIO Keel Point. We are a RIA and broker-dealer. About $3 billion under management, $2 billion discretionary, $1 billion advisory, and have offices sprinkled in the Mid-Atlantic and Southeast.
And Andrew Cry with Crescent Grove Advisors, headquartered just up the road here in Lake Forest, Illinois. Based in Milwaukee, we also have an office in Atlanta. Manage about $2.8 billion in assets for about 160 families. So ultra high net worth type space. Also do sort of comprehensive financial advisory. So everything from consulting on estate planning, employee benefits, preparing tax returns, all that, in addition to the bread and butter business, which is investment management, portfolio management.
Well, thank you. Obviously, on the outside looking in, RIAs all look the same, but there's nuances in each firm. We sit here, we have a room full of sales professionals.
Right.
You just enlighten them on what your day's like. You're not sitting in front of a screen 24/7 waiting for one of us to call and show you an idea. So how do we understand your daily routine and how we be sensitive to showing you an idea?
All right. Well, to begin with, the way our firm is set up, we all have divided responsibilities. All of us that sit on the investment committee actually have direct client responsibilities, so that's really our day job. All of the work that we do for the investment committee, whether it's manager due diligence, performance measurement, is all incidental to our day-to-day responsibilities. What that means is we have very limited time to devote to probably one of the most crucial elements, which is the manager selection process. And so I've got a team of colleagues that work alongside me. I oversee all of our manager selection work. And as a result of doing this on a part-time basis, we actually have engaged an investment consultant, Mercer, to work alongside us to provide the due diligence and quantitative analysis that we can rely on in terms of decision making. So our process is a little bit more structured than perhaps what you might see at other firms. But given the level of assets that we deal with and the fact that we're dealing with people in offices all around the country, it's helpful for us to have some sort of structure in place that we can fall back on. And so normally when people come in to talk to us, the first question right out of the gate will be, are you on the institutional radar? Have you been through the vetting process with our consultants? If they have, then that obviously facilitates the conversation going forward. And if they haven't, then we do some additional work to see whether it makes sense for us to go through the process. In some cases, they may help us fill gaps in terms of the offering that we have. If we're seeking a particular strategy and we don't have access to it through other means, then we might go through the full due diligence process with a new manager. But that's typically the starting point for the conversation.
Is it a final question with Mercer? Does one need to be rated at Mercer to have an audience at HPM, or?
Ideally, if they have a rating, that facilitates the whole process. If they haven't been fully rated, but if they've actually been through a less rigorous vetting, and Mercer comes out and says that it's supportive of the manager, but because of the amount of assets that they manage, they may not be suitable for their institutional clients, that's generally enough for us to go by. And in other cases, they may have commissioned an operational risk assessment report.
Excellent. What we're finding is Mercer starting to show up on the radar of RIAs,
right.
No CIO business, banks, so probably educational, just understand that relationship.
Right.
Gil, family office, a little bit different, a lot of private structures, one family. tell us about your day, and then, probably not a lot of turnover in the portfolios we've discussed, maybe not the need for a lot of velocity of communication.
Yeah. Look, I think if you know one family office, you know one family office. I mean, my day is highly, I would call it unstructured. Every day is different, which is good. I mean, I spend a lot of time on the road because I feel like for us, we don't have a consultant on our account, so all of the ideas are generated in-house with our frankly small team. There's only 5 of us, but I think what is unique about most of the ideas that have made it into our book is that they have come either through an existing manager in our portfolio that we really like, and that's kind of constant communication with them, being like, you meet with them in New York or wherever there are, and they ask you, what are you spending your time on? And you're like, oh, we find this space interesting, and almost always they'll be like, oh, have you met X? I worked with him, back when, or I crossed paths with them, or we share ideas on a few names, and that's a great way to get introduced to new ideas. Or frankly, do you know the people over at X, Dakota, or at this cap intro, or this third-party marketer, and that's helpful. But also, I find being on the road helpful to meet with other investors or family offices or RIAs, because that level of communication is great, because you get to know them and you understand which people think like you and which people.
So there's a viral nature to the family office business.
Absolutely.
We tend to speak to each other, although it might be clandestine to find, but you guys are.
Without a doubt, and that's one of the constant kind of, not complaints, but issues with the family office network, is that almost none of us have websites. Everybody's got an obscure name. Very few people put the family's name on the door. So the network among family offices is very insular, and it's very clandestine is a good word. But it's also, once you kind of meet 1 or 2 or 3, there's a lot of networking that does happen. Here in Chicago is a really good family office community. I mean, there's probably 30 to 40 family offices with north of $1 billion that I'd say 25 of them people have never heard of, but they're around. And we get together probably once a year. There's a couple of dinners for CIOs of family offices. There's a couple of cocktail events and things like that. And then you form relationships with other counterparts at other family offices, where you go and you catch up every quarter, every 6 months, and some of our best ideas come through them. But in terms of kind of getting our attention, what I like is on the sales side is people that actually listen to you, right? And they understand what you do and what you don't. And whether it's having a relationship with Mercer, like on his side, or simply just listening to what we look for in our managers is key, because that's, I'd say, the vast majority of people on the sales side, they don't listen to you, and they come to you with things that, if they went back in their notes, they would know it's not going to happen, right? And you don't want to be rude, and you don't want to not return emails or phone calls, but it's a challenge given the amount of inflows that you get, right? Once you're on a few of these lists, or once you're more in the market, it's just not possible to respond to.
Yeah, I think the thing that we've proven out from the endeavors for this conference is email is a very difficult way to get people's attention. But there's just, we have a room full of salespeople, and you're looking at a lot of emails coming at you, but there's other ways.
Without a doubt. I mean, the way that I view it is, email is difficult, particularly if I don't have a one-on-one relationship with the person. It's simply just going to get filed away, and if there's a voicemail and an email, or if we've met in person, relating the conversation that we had in person, it's just better that way.
And we'll touch on some funny stories, and hopefully they don't involve anybody in this room. But let's get to Lyle. Lyle, we had breakfast a few months ago in Philadelphia, and you were expressive that you are the CIO, you choose managers, but you have other responsibilities. You have some internal strategies. You have demands that your whole day cannot be spent looking for ideas. So how do you reconcile your functionality of your internal strategies that you manage, and the need to really serve the purpose for your clients for finding the best ideas?
Yeah, so I guess like the rest of these guys up here, I would definitely less than half of my time is devoted to thinking about allocation decisions on a day-to-day basis. My time is split up between on the management committee of our firm. I oversee our internal strategies, client-specific issues, both with prospects and current clients, and then portfolio allocations. So for us, I think like most of us, we're looking for scale in any way that we can get it. We can get lost in a quagmire if we tried to deal with every sales proposition that comes over the door and dig into it in a fundamental way. So we're very big on using analytics. We're not using a Mercer. We've developed our own analytics, and we're very big on screening and looking at the types of characteristics that we want to extract from any marginal investment. So we try to keep a balance between passive and active, and where it's active, we try to know analytically what we're after and what we expect from the investment, and then that helps us gauge performance assessment going forward. We don't care necessarily if we're not getting alpha from a particular investment, as long as it's following a script, meaning that in our quantitative assessment of it going into the investment, we didn't think it would deliver alpha necessarily in a given period. So we're okay with that. What really gives us angst is when something breaks away from the script. So for us, like you, when answering emails and emails followed up by phone calls is very difficult for us. So we try to manage, my team has 7 people on it. We try to leverage with responsibilities across the portfolios. And the best thing that you all could do for us is, when you are contacting us, is to give us that, the differentiated performance characteristic. That's what will catch our eye, because as our view is we're increasingly late cycle, we are looking for differentiated sources of return. If you can quickly get to what your product is offering in that regard, then that would allow us to go back and look at it analytically, and if it kind of meets the sniff test, we might engage.
That's a great point for the next question in terms of what you want to hear in a meeting, but we'll wrap it up with Andrew in this set of questions. Andrew, you've been a good friend. You've allocated some of our strategies. You're one of the most polite person to say no to an idea, which is very helpful.
Thanks.
And you're very polite to say yes to an idea. Your day, I mean, obviously knowing you all the way back at M&I Bank, BMO, and things, how your firm's grown nicely, which has probably put a lot more responsibilities on all the professionals there. So back to the question of sourcing ideas, how to reach out and being sensitive to what you're doing on a daily basis.
Yeah, so first and foremost, everybody in the investment committee, we have a committee of 5 at our firm, they're practitioners. It's all, clients are at the end of the day what is sort of the lifeblood of the business, right? So we have to make sure the clients are happy. Portfolio management, and like I said, it's not just in the investment side that we're working on. It's all these other ancillary parts, the estate planning, the tax piece, the employee benefits, understanding how all that fits together. So I manage a book of 6 client families. Our CIO manages about 10 client families. So that's really first and foremost in our day. And then it comes to the platform. And really, we've had long-standing relationships on the traditional long-only fixed income, long-only equity side of things. It's really the alternatives where we spend a lot of our time focusing, trying to source sort of niche-type ideas that would be differentiated. And again, using our size, I guess, to an advantage as well. The fact that we feel like at $2.8 billion, we're not pushing around $500 million, $1 billion at a time. We can allocate 20 to 50 million, and it's worth our while. So, trying to find strategies that may play in more inefficient pockets of the market, that's really where we're going to spend a lot of our time. Drawdown structure funds, things that, not necessarily evergreen type structures, where again, we feel like we have some sort of exploitable advantage there. So, most of our time, I would say, is spent on the alternative side of the research process. And again, in those more sort of underserved niche type of strategies, and how do we get there? To the point that these guys have made. Candidly, it's not unsolicited emails and phone calls from the marketing and sales folks. with apologies, it's largely, everybody has a funnel, right, in some form or fashion. For us, it's really a warm introduction, a warm lead from an existing, could be from a client. We're really agnostic as to where the idea comes from, but a lot of our best ideas have come from clients that have sourced things through their little cocktail circuit or whatever the case may be. But then also other folks, trusted partners that we've invested with in the past, folks like Chris and Dakota. That just sort of that preliminary filter for us. If it makes it through that and we feel like we've got a trusted referral through our network, then we're willing to kind of take it that one step further. But candidly, there's just too much at the top of the funnel for us, to spend time on everything and to give it the attention it probably deserves. It just it doesn't fit into what we do in terms of our bandwidth that we have to work with.
No, very helpful. Thank you. I'm going to turn the fire up a little bit here to the sales professionals. You've chose to take a meeting. What do you really want to see in that meeting? I mean, Lyle just touched on it, giving us some parameters let's get to the point, Mr. Sales Professional and Mrs. Sales Professional. Give us some insight, when we have your attention, which is, it's difficult to get your guys,
Right.
You're busy. How do we present our story in the most succinct fashion?
Well, what I find very helpful is if people come into the meeting with some idea of what we're already doing, and there's a fair amount of information available on our website. So if they've done our homework, we can go through the preliminaries and really get to what it is that they have on offer. We talk a lot about the market opportunity. Part of it is information seeking, part of it is educational. And the most valuable part of the conversation is perhaps understanding how, given the current market environment, the strategy that they're pitching makes sense. And that's probably the most frustrating thing about taking a lot of meetings off the cuff is people come in, they have a product to pitch, they don't necessarily know that we already have existing exposure and don't need any additional exposure in that area, or they come in and ask a lot of very basic questions about a firm that they could have checked online. So that takes up a lot of the discussion time. I'd rather talk about what's going on in the market, how does their product or strategy fit in terms of the current environment, and then talk about the mechanics of the strategy in terms of expected return, risk profile, what it does in terms of the overall portfolio.
We all seem to allocate an hour, let's say, to a meeting. Should all meetings last an hour? Or if done correctly, should they last 37 minutes?
It varies. There's some meetings I'll wrap up in 15, 20 minutes. And those typically tend to be with people that we've worked with in the past, where there's a level of understanding, a level of trust. And the most valuable thing I find is if they send over the materials ahead of time, I can do my homework as well. Just as much as I task them to do their homework, it's incumbent upon me when I go into a meeting that I've actually read through the materials, so I'm not asking them the same basic questions that I could have answered myself.
Oh, thank you. That's great. Gil, as I said, a little different, smaller portfolio privates. However,
Yeah.
if you're going to meet with somebody, chances are it's something that's caught your eye. Then
Absolutely.
how do you address the time commitment to a meeting?
I think materials in advance are 100% required. I mean, I want to go in there and, sometimes they come in and they give you like a new deck. And my first question is it different than what you sent me? Because I've got notes in mind. So
How many of those decks wind up in the trash can within 3 hours after the meeting?
I'd say 3 out of 4.
Okay.
But we run a pretty concentrated portfolio. But look, going back to the duration of the meeting, I've had meetings where after 25 minutes, frankly, I've heard enough, and it's like, we're going to send you a list of due diligence requests because I really like what I've heard, and I've heard enough to say we're going to do work on this, right? And if I need that full hour, a lot of times that can almost be a bad sign where it's like, I still want to hear more, right? And my mind isn't made up. And then I've had meetings where after a half hour, I'm just like, this isn't for us, right? I'd say one of my pet peeves is when managers come in and the first half of the meeting is spent talking, or the first maybe few pages of their deck is all performance. And it's like, that's already been done, right? Like, I want to hear clarity of strategy on your end and how you go about executing that strategy consistently, right? And examples are great. I love hearing examples, a recent example of a new name or a name that didn't work, a lesson learned, things like that I find very helpful to understand how the strategy is actually executed. But the first thing I want to hear from certainly the investor, the PM or the analyst, is how they formulate their strategy, why the strategy has worked, or maybe if it's a new launch, how it's going to work. But clarity of strategy to me is paramount. And then after that, go into how you execute it. But I don't want to hear about performance in the meeting. I've already gotten that, right? It's like that should be the last page in the presentation.
Yeah, I think that the exercise here is we could probably extrapolate a lot of thinking across more firms. You've basically said the same things of just let's have better preparation so we don't have to get into the minutia of, hi, this is who we are, and let's just get down to it. Lyle, you can expound on what you started on in the last question, just the demands that you want to see, because we all are compressed for time, so our minds work to the most efficient way. So if you expound on when somebody comes in and visits with you.
I would say we have gotten to a point, we don't take meetings anymore unless we have convinced ourselves that something has caught our eye with respect to some kind of characteristic that has our interest, and then we want to take the meeting. I mean, that is maybe not 100% true right now, but we're driving that way. We really don't want to have just the general information meeting. And so that gets back to when we're contacted, I think what we're really looking for is getting right to the point on that initial contact is this is the performance characteristic that we think you should be interested in. And then to your point, we can go do the math on the returns to convince ourselves that, that really is there. Let's dig in and find a little more. And I would say, too, I spent 15 plus years on the street, and part of that time was selling, sitting down talking to institutional investors about products. And the one thing that I found seldom resonated well was when I sat down with someone and said, you know what, here are all the widgets I want to sell you. Here's why you need to buy these widgets. And I found it much more effective to sit down with someone and say, you know what, tell me your problems. Tell me your issues, and I know my firm well enough to know if we can deliver into those issues. And if not, I'm not going to waste your time or my time. And if so, here's what I think you need to think about. And after you build some credibility with somebody, you can have their ear on those types of issues. And I think my observation is that many times a salesperson will come in or contact you, and you say, well, what kind of characteristic, what are you offering? What's differentiated? And you don't get much more than like, hey, we've been in the top, we're in the top quartile for the past 3 years. So back to you, that's not gonna do it for us.
But it's good to know. Keel Point, I mean, a well-known firm, Huntsville, Alabama, very smart workforce with all the engineers down there. The fact that you're not taking meetings, one should not really take it personally if you're not hearing back. It's just the way that you're thinking right now and the way you're structured, which is.
Yes, no, if we're going to devote time, and we run a family office out of DC, so we'll meet in both locations, and I spend a lot of time in both places. But if we're going to take a meeting now, then it's a very good sign that we're interested. So we don't want to waste your time. We don't want to waste our time.
If Keel Point takes a meeting, sales professionals be prepared to tell the story because there's probably some interest.
Yeah.
That's good. That's a good sign. Andrew.
Yeah, I would say we want to spend a lot more time, really to repeat a little bit, but we don't want to look at performance necessarily. We don't want to look at just the pure stats in the portfolio. We want to spend more time being Socratic about the why, why you do things the way you do. Challenge some of the assumptions that you have on an underlying basis. There are probably people in the room that I've taken meetings with actually that probably say we don't do any of this, but at least this is how we try to intellectually approach it, is to kind of question everything. And so what we really appreciate is when people come prepared to speak on those points as opposed to really just the high level superficial data about the portfolio. And then again, reiterating a bit of what you heard, sort of a cogent, concise reason for what type of markets you expect to do well in, what type of markets you don't expect to do well in, an understanding of what really drives portfolio returns or what you expect to drive portfolio returns over the long term. Again, getting away from just that really superficial level data, getting deeper into that, understanding process, how the team functions, et cetera. Sort of tried and true due diligence areas to cover, but by the same token, to do it well and to do it concisely, cogently, I think makes a huge difference. I'd say one thing, that has been something we've found over the last few years especially, it's been a huge help to us, is a well thought out, thorough DDQ. We love to see those documents, to have that in sort of our repository of data on a manager. The meeting's great, but to have something that we can go back to that's really, it puts it all in writing, spells it out. And again, some people just do it at a really high level. That's okay, but we prefer to see that really thoughtful, well put together DDQ. We just find that very helpful to have on hand.
That's great. We have 10 minutes left, so we're going to ask everybody's outlook and any near-term search activity, just for the crowd, if there's some ideas. So I'll start with you, Krim. Is anything front burner searches right now? Because we want to be able to take some questions. We can blow through this in 5 minutes, so we can take some questions from the audience.
Well, one of the areas we're looking at is, just given the current market situation, is focusing more on alternatives. And our typical strategic allocations alternatives are already quite high, so we have anywhere from 30 to 40% allocated across hedge funds, private equity, private debt, real estate, infrastructure. Our expectation is, given the outlook for fixed income, current valuations in public equities, we're probably going to be looking more to the private markets, both for risk reduction opportunities as well as for return enhancement. And within that category, probably the one area that I'm currently focused on is what's going on with hedge funds. Category is still deeply out of favor, particularly with a lot of clients. And from a contrarian standpoint, we feel like this is absolutely the time to be focusing on that. So within hedge funds, rather than do something on the multi-strat side, we're actually looking at individual strategies that would make sense in the current environment. Probably top of mind would be event-driven. We do think the environment is probably more conducive to merger activity than we've seen with the previous administration. So we'd like to get some managers there that can help us. And then other categories of hedge funds that we're focusing on, more for diversification opportunity, very quantitative strategies. We're talking to you about one of the managers that you've brought to the table. Yep. Our expectation is we've already got good allocations to fundamentally driven parts of the portfolio, whether passive or active. But this does seem like another element that can provide a level of diversification as well. So those are probably the two top of mind.
That's very helpful. Thank you. Gil?
Similar. I would say that we've been increasing our hedge fund allocation over the last year as it's become more and more out of favor. We've liked it. We have about over half of our book in alternatives, but I think right now the main focus for us is strategies, and this is a kind of all-encompassing where you can apply it to either private equity or special sits or hedge funds. Strategies where you can control the outcome of individual positions. So whether that's event-driven or activist, or a special sits where you take control of the company and you buy it for cheap because it's getting spit out, but something where the catalyst for your return or alpha is independent for the most part of broad market.
So for private equity, you're looking for control positions?
Absolutely.
In private equity? Okay,
yeah.
that seems to be a pretty consistent.
And even on the hedge fund side, things that are, whether you're buying a piece of distressed debt, they're getting on the steering committee, and if it's going through an out-of-court process or even in court, they are involved in what they're going to get for their individual piece.
That's back to the point of if you like your ideas, like them a lot.
Exactly.
Really own them.
Yeah.
That's excellent. Well, obviously you're talking about return characteristics. So are there any return characteristics you're looking for right now that could cause you to potentially respond favorably to an idea?
So we bifurcate the world generally into aggressive and then defensive exposure. On the aggressive side, and these are kind of defined by vol and beta. So on the aggressive side, we're looking at vol and beta relative to equities. And on that side of the equation, we're very interested right now in what we call flexible beta, which beta that's not stable, so that usually equates to trading strategies. And over on the defensive side, we're very interested in defensive alts that are, we're looking to dampen down equity risk, but somewhat unhinged from interest rate risk.
Excellent.
So we're looking for not a lot of ag beta, but can still provide some defensive characteristics, for the obvious reasons.
Excellent. Last question before we take some questions from the audience. Andrew, the same outlook. Andrew, by the way, if you've ever had a chance to meet with Andrew, Milwaukee's a great town, but Andrew always has great ideas. Not that you guys don't, but I always...
So one right now that we're looking at, there's been a ton of money raised in private direct lending, senior secured lending over the last few years especially. A lot of Me Too players, we'd say, in that space that just want a seat at the syndicate table. We think if we see a cycle over the next 2, 3, 4 years, which we think we probably will, at least in our view, that there's going to be some opportunities in the secondary market there. So playing distressed private debt actually looks like an interesting play for us. That's something we're doing some homework on, trying to find the right way to attack that, the right manager and strategy. So that's one that's high on our list. And then another, just more broadly trying to look at secular themes, one being sort of demographically driven real estate. So medical office and seniors living, two spots where we've done some deals in the past and we'll continue to look to find opportunities there just because we think the demographics are so favorable for those spaces to continue to perform and certainly outperform more traditional, little valuation-rich, heavy, commercial or traditional multifamily.
That's great. Well, let's take some questions from the audience. If there's anybody that wants to ask. Otherwise, I will ask them for funny stories about salespeople. So you choose. So we have a microphone. I can't see anything, so. Hey, yeah, please.
What's easiest for the structure of your organization? And secondly, do you think looking forward in a potentially quantitative tightening environment, do you think passive or active will become a larger percentage of your capital?
Anyone want to take that?
I mean, in terms of an illiquid strategy, for me, the structure is almost indifferent as long as the terms for investors are appropriate for said illiquidity, right? I mean, if you're trading, middle market select distressed debt and you have monthly 15-day liquidity, that's a problem. Oh, you said liquid. Oh, I thought you meant illiquid. I mean, we pretty much invest everything through an LP. If it's beta in a tax advantage equity, then we'll do an SMA. But for the most part, we're invested in LPs.
We'll use all of the above, but depending on the liquidity of the underlying asset class, a lot of times the diversified strategies in mutual fund or SMA format will be just fine. When it comes to things like managed futures and other liquid alt strategies, if the underlying structure and market is very liquid, we don't see any reason to wrap it up in an LP just to be able to get access to the asset class. So in a lot of cases, we'll work across all three, funds, SMAs, and LPs.
That's great. Is there let's take one more question because I think we're running out of time. Is there any other questions? Or it's like being in the police station. These lights in your eyes.
Hey, Chris. Sorry.
Yes.
Guy mentioned at the start of the conference the behavior of the millennial generation and for the panelists and how they look at investments and their usage of the internet, transparency of information, Bitcoin investments, for instance, as well. Do you see them getting more involved at the family office level and impacting the way you look at ideas and how you all operate and invest?
You want to take that, Andrew?
Yeah, candidly, we haven't had as much interaction with the second and third generation. Most of our families are first generation wealth. But that said, we've started to try to look around the corner a little bit and understand that that's coming. So things like impact investing, obviously ESG, SRI, we've done more and more work to have capabilities built out for when that time, that necessity is there. And then the other big component of that for us is building out the technology side of things. So making sure that our reporting, our online access and capabilities are up to snuff with what would be expected of a millennial or certainly somebody younger who's more tech savvy and would appreciate not only appreciate but expect that level of access, transparency, et cetera, on a day-to-day basis. So a couple of things that we're doing to get out ahead of it.
Anybody have any else?
I'll just add quickly. We do interact with G2s and G3s, and it is a big issue.
Yep.
And we feel like it's going to become increasingly prevalent on an investment objective that we have to meet. And frankly, we are in the process of thinking about how we up our game in that area.
Well, listen, we've established that obviously individuals like this and throughout all the panels, their time is precious. They've a lot of demands on them from the sales professionals. And for them to take time out of their morning on a Monday to spend time with our audience and us at Dakota, we're grateful. Thank you very much. Thanks, guys.